Good morning, everyone. It's a real pleasure to be here today talking to you about quite an interesting topic. I really want to cover three things with this presentation. So the title of the presentation is Future Fit Ships, How to Maximize Existing Assets and Replace Fleets Through Transitional Times. I'm going to touch on how we extend the life of existing assets, extract maximum value from those ships, then how we think about fleet replacement and making the right investment decisions, and then finally touch a little bit on future energy cargoes and the sort of multi-gas carrier concept. So I'd like to first touch on sort of, just a slide to set the scene, give a bit of context on sort of Lloyd's Register's thinking behind the, or around the energy transition. Really, we see this as a combination of technical and commercial challenges wrapped up in ultimately a strategic opportunity for stakeholders. Really, what I mean by that is, yes, we are aiming towards reducing emissions across existing assets and future vessels, but also this is an opportunity for all stakeholders to set up their businesses for the future and improve that sort of competitive positioning in the market. And in Lloyd's Register Business Advisory, we're working with stakeholders from across the value chain. So that's owners, charterers, financiers, ports, energy majors, and alternative fuel producers to sort of tackle these challenges. And the way we frame that is there's sort of two angles. There's a sort of bottom-up approach where we look at the assets and say, okay, what are the emissions coming out of these vessels? How do we reduce those emissions? But then also taking a top-down approach, forward-looking, what are the right fuels for a fleet of vessels? How does that work with regards to sort of business strategy and so on? So I want to touch on the first question, which is how do we maximize life from our existing assets? So we know that in order to decarbonize, we need a fuel change. Unfortunately, that fuel change isn't going to be available or possible in the short term. So the right thing to do is to maximize and squeeze out as much value from the existing ships in the fleet as possible. So we've been doing a lot of work with leading ship owners to develop their energy transition strategies. And what that essentially entails is sort of plotting the course over the next 10 to 15 years of what owners need to do to keep their vessels in compliance or to align with emissions reduction trajectories. So what I'm presenting here is an example of some of our techno-economic modeling, where we take a vessel, we take a target trajectory, and we build a chain of solutions, starting with the quick wins to keep that vessel in compliance. What we believe is that there's no sort of silver bullet to this, which is one of the buzzwords of one of these presentations. But really it's about building a chain of solutions. So starting with operational optimization, then ESDs, drop-in biofuels, engine retrofits, and then fleet replacement ultimately. And this is an example for an actual vessel where we've built these pathways for some of our clients. I then want to look at the more sort of, the sort of slightly more ambiguous question of what do we do about fleet replacement? How do we replace these assets in the global fleet? Make the right decisions. I started my career working for a large tanker and dry bulk owner, and when we were evaluating new builds, we basically asked ourselves two questions: can we run the ship, and can we make money from the ship? And really, we only needed to answer the latter because we felt we could run any ship. Now, answering that question was very easy, 10 years ago or so, but now answering that question, can we make money from this asset, is far more challenging. That's due to the changing regulatory regime, the sort of tiering of the shipping market that we're seeing, and we will continue to see, with what the EU is doing and so on. But really, the consequences of these increased risks are quite severe. We're talking about the stranding of assets, high regulatory penalties, and loss of market share. So this is really quite a sort of spider's web of challenges for owners, charterers, and financiers when assessing this. Sort of being a consultant, I like to break this down into some sort of simple framework. So I like to think of a new build as two components: a technical spec or specification. What I mean by that is really a relationship between speed and fuel consumption, and then an operational profile. And what I mean by that is a matrix of operational parameters, so speeds, ballast and laden conditions, EU exposure, and so on. And what we've been doing in LR is sort of modeling, vessel operations and, by applying operational profiles to these new build models to assess new build opportunities from the perspective of both charterer and owner. That gives us quite a few interesting outputs. We can look at the emissions profile of a theoretical new build. So what will the CII look like for that vessel, depending on how it operates? What will the greenhouse gas intensity look like? How will that decline over time? But it also allows us to look at the costs associated with that vessel. So we can look at a sort of total cost of ownership model where we're able to determine, well, what's the total fuel cost across the lifetime of the vessel? What are the regulatory penalties? What's the additional capex that needs to be put into the asset, and so on? And we can do that across a range of fuels, a range of technologies, different vessel sizes, and so on, and test the sensitivities around operational changes, fuel prices, et cetera, to allow for well-informed investment decisions. So we've been doing this for sort of leading ship owners across segments, but also increasingly for financiers, looking at their portfolio and saying, well, to what extent does this new build opportunity help us to align with Poseidon principles or our internal sustainability goals? I then would like to touch on sort of future energy cargoes and bring in the sort of concept of multi-gas carriers, which is a really hot topic in the industry at the minute. A multi-gas carrier is essentially an LPG carrier that can carry both LPG and ammonia. And what that allows that vessel to do is triangulate trade between two cargoes to essentially optimize utilization and maximize value from that asset. The trend at the minute is to look at multi-gas carriers, as the energy mix, evolves, but also to bring in liquid CO2 as a sort of third cargo on that vessel. The idea being is that you build the perfect vessel that can carry three cargoes and therefore optimize that utilization. And what I'd like to explore today is that although that's technically feasible, is that operationally practical? And will that actually give the commercial optionality that we would hope for? So what I did was I looked at the trading patterns of mid-sized LPG carriers today that triangulate trade between LPG and ammonia. Looked at the terminals they call at, and then started to overlay major potential future CO2 storage locations. So this is by no means an exhaustive list. Australia is somewhere behind my picture there. But these are locations where there's large saline aquifers or oil and gas reservoirs where CO2 can be stored. Start to look at also potential future ammonia trade. As we move into the 2030s, we expect large volumes of ammonia to be traded globally. We're going to see significant amount of ammonia flowing into North Asia, as Korea and Japan transition their power generation sector away from coal towards ammonia. So we are going to see ammonia being part of the energy mix. So what does that mean in the context of multi-gas carriers? So what I did was I looked at the existing fleet of LPG carriers, mid-size, so 40 to 46K, and looked at the percentage of voyages over the course of a year where those vessels are in laden condition. So this is essentially a proxy for utilization. And what I found was that most, on average, those vessels are 60% of their voyages across a year are laden. So that means there's already a significant amount of optimization going on around utilization if we think of a baseline of 50-50. So the question is, if that's, we can get 60% with LPG and ammonia, two questions. Will that rise as the volume of ammonia being traded also increases? And will that percentage rise if you bring CO2 into the mix? The answer to the first one is fairly easy. We expect significant amount of ammonia demand to increase, so we'd expect that percentage to rise. But when it comes to CO2, I'd actually, estimate that percentage will actually be throttled, if not, sort of reduced. And the reason for that is really four main elements here. One is to make a multi-gas carrier capable of carrying CO2. you need a stronger steel in the tank, so a higher yield strength steel. That's because CO2 is significantly heavier than ammonia and LPG. That has two effects. It raises the costs. We estimate a premium of around 15%. So if you take the price of a current LPG carrier, we're talking about a $9 to $12 million delta on that investment. If you add in a dual fuel option on that vessel, you maybe add another 10 to 15%. So we're talking about 25 to 30% additional capex on that asset. That's enough to make even the most steely ship owners sort of start to perspire a little bit, I would say. The second element is the weight. So stronger steel, heavier material increases the weight of the vessel. That impacts range, drives up fuel consumption. So there's a real question over whether these vessels can actually triangulate trade. So will a vessel be able to ballast far enough to pick up another trade for a backhaul operation? So that may be a real limiting factor on the operation of these vessels. Thirdly, these cargoes cannot be mixed. So, for example, ammonia and CO2 is reactive, creates urea, which is fertilizer, so that sort of defeats the purpose of being able to follow this model. So the tanks need to be completely cleaned. That means, sort of evaporating off all the cargo. For a mid-sized LPG carrier, we estimate that could take about 6 or 7 days. You stack that up over the course of the year, maybe you do that 4 or 5 times, that's a month of off-hire time. That's without considering any other off-hire operations as well, so also considerable and going to hit the voyage economics for that vessel. And then finally, there is a misalignment of trading profiles between liquid CO2, ammonia, and LPG. There isn't a clear triangulation trade there between the three. So that's going to be a real challenge there. So my thesis here is that as we move into the 2030s, multi-gas carriers that can carry LPG and ammonia will be vital. They will offer owners considerable commercial optionality, being able to carry both cargoes, particularly as the demand for ammonia ramps up considerably. However, we're more likely to see dedicated, smaller liquid CO2 carriers being built with different voyage dynamics. And those CO2 carriers will be tapped in and tightly dialed into the CO2 value chain. So really, servicing these key storage hubs around the world. Very similar to what we saw with LNG, where we saw the LNG gas trains being developed, the SPAs being signed, and then the ships being arranged finally. We're going to have to see a similar dynamic with the liquid CO2 market as well. So quite interesting, obviously gaining a lot of traction in the market, but I think it's important to think about, although something may be technically feasible with these new technologies, new cargoes, it's really important to think about how these vessels will operate and whether that will actually give stakeholders the required optionality and commercial upside that they're looking for. That's everything I had prepared for today. Thank you very much, everyone. Hope that was somewhat interesting, and we can, continue the discussion, over the course of the day. Thank you.